I've been in this game long enough to see the same mistake repeat itself in every generation of traders. The market changes its clothes, the charts get cleaner, the tickers flash faster, but the human mind stays stubbornly the same. And there's one trap it loves more than any other. It whispers to you right after a trade closes. Sometimes after a win, sometimes after a loss. It says, just one more trade. Have you heard that voice? Of course you have. Every trader who's ever lasted more than a week has. Now listen closely, because this trap doesn't feel like greed at first. It feels like opportunity. You've just booked a profit, and the tape still looks alive. The bars are still forming. Volume is still talking. You tell yourself you're warmed up now. You're in sync with the market. Why stop when you finally feel sharp? That's the moment the market starts taking notes on you. I learned early that the market doesn't reward activity. It rewards patience. Charts don't pay you for clicking the button. They pay you for waiting until the line you've drawn is no longer an opinion but a fact. But when that "one more trade" thought creeps in, facts get blurry. You start seeing patterns that weren't there 5 minutes ago. You widen your stops just a little. You shrink your targets just a little. Tell me, have you ever entered a trade knowing it wasn't quite right, but convincing yourself it was close enough? The dangerous part is that sometimes the market lets you get away with it. That's how the habit is born. You break your rule and the trade works. You do it again and it works again. Now your mind draws the wrong conclusion. You think your instinct is improving, when in reality your discipline is eroding. The chart didn't reward your recklessness. It simply hadn't punished it yet. I've always said that a man must study himself before he studies the market. When you feel the urge for just one more trade, that's not analysis talking. That's emotion wearing the mask of logic. It might be excitement. It might be frustration. It might be the simple discomfort of walking away from the screen without action. Ask yourself honestly, are you trading the chart, or are you trading your own need to feel busy? Look at a clean chart after the close. Notice how obvious the good trades look in hindsight. Wide bases, clear breakouts, proper volume, plenty of room for price to move. Now compare that to the trade you took because you didn't want to stop. It was usually late. It was usually crowded. The reward was small and the risk was hidden. That's no coincidence. The best trades don't beg you to take them. They sit there quietly until you're ready. Wealth in trading is built the same way price builds a trend, slowly, unevenly, and with long stretches of doing nothing. But the mind hates inactivity. The mind wants constant feedback. It wants to feel involved. That's why traders overtrade, not because they want to lose money, but because they want relief from waiting. Isn't it strange that the hardest part of trading is often doing less, not more? I've watched men give back a week's work in an afternoon because they couldn't accept a good day as enough. They made their money before lunch and lost it before the close. The chart didn't change. The market didn't trick them. Their mindset did. They stopped trading to make money and started trading to stay entertained. Once that happens, the tape might as well be noise. When you say, just one more trade, you're usually ignoring your own records. You already know your edge works best under certain conditions. You've seen it in your journal. You've seen it in your equity curve. Yet in the heat of the moment, you act as if this trade exists in isolation. It doesn't. Every trade is part of a series, and series are what make or break a trader. Have you ever noticed how one impulsive trade often leads to another? The market senses urgency the way a shark senses blood. When you rush, you stop waiting for confirmation. You anticipate instead of reacting. You enter before the breakout proves itself. You exit before the move has time to mature. And then you wonder why consistency feels so elusive. Consistency isn't found in clever entries. It's found in repeating the same behavior even when you're bored. A sound money mindset understands that capital is inventory. You don't waste inventory. You deploy it when conditions are favorable and protect it when they're not. Every unnecessary trade is a fee you pay to your own impatience. The market already charges enough. Why add to the bill? Ask yourself this the next time you feel that urge: if this trade loses, will I still be proud of taking it? The tape tells the truth, but only if you're willing to listen without interrupting it. When you force trades, you drown out that message. You stop reading price and start projecting hope. That's not speculation. That's gambling dressed up as analysis. I've never met a successful trader who made his fortune by squeezing in extra trades at the end of the day. I've met plenty who lost theirs that way. There's a quiet confidence that comes from closing the platform and knowing you followed your plan. Even if you made nothing that day, especially if you made nothing, because that tells you something important. You can wait. And if you can wait, you can survive. And if you can survive, you can compound. The market doesn't care how badly you want the next trade. It only responds to discipline over time. So the next time your finger hovers over the mouse and your mind says, just one more, pause and look at the chart as if you've never seen it before. Is this really a high probability setup, or is it just familiar motion? The market doesn't reward activity, it rewards timing and restraint. That lesson cost me more money than any bad tip or false breakout ever did. Because activity feels productive. Sitting still feels like wasting time. And the trader who doesn't understand the difference is always working hard and rarely getting paid. Have you noticed how busy losing traders always are? Early on, I believed the more I watched the tape, the more I traded, the sharper I would become. I thought constant engagement would tune my instincts. What actually happened was the opposite. The more trades I took, the less selective I became. The chart stopped being a guide and started becoming an excuse. Every wiggle looked actionable. Every pause looked like a setup. That wasn't skill improving, that was discipline dissolving. The market moves in rhythms. It breathes in trends and rests in ranges. Most of the time, it's doing nothing worth paying for. Price wanders, volume dries up, and smart money waits. But the active trader feels uncomfortable during these stretches. He feels left out, so he manufactures reasons to trade. He calls noise, early entry, and impatience, aggressiveness. Tell me, how many times have you entered simply because you were tired of watching? Timing is not about speed, it's about alignment. When price, volume, and structure agree, the trade almost takes itself. You don't need to convince yourself. You don't need to force confidence. The chart speaks plainly. But these moments are rare. And because they are rare, they require restraint the rest of the time. That restraint is what most traders mistake for passivity. I've always trusted the man who trades less but waits more. He understands that every trade carries friction, commissions, slippage, mental fatigue. Activity compounds those costs. The market doesn't pay extra for enthusiasm. It doesn't care how alert you are or how many screens you're watching. It only responds when you act at the right time, not all the time. Look at any chart and mark the areas where real money was made. You'll see long periods of sideways movement followed by decisive expansion. The profits come from the expansion, not the waiting. But without the waiting, you're not positioned for the expansion. Most traders exhaust themselves during the quiet parts and arrive late to the move that matters. Isn't it ironic that impatience is what makes traders miss opportunities? Restraint is not fear. Fear hesitates when action is required. Restraint waits until action is justified. There's a difference, and the market exposes it quickly. A fearful trader avoids good trades. An undisciplined trader creates bad ones. Both lose money, but only one understands why. The trader who respects restraint knows that not trading is sometimes the most profitable decision available. Your equity curve doesn't rise because you were busy. It rises because you participated in a small number of favorable situations and stayed out of the rest. That's not exciting. It doesn't make for good stories. But it builds capital. Wealth in trading is quiet. It grows while the trader is bored, not while he's excited. I've seen traders mistake restraint for missed opportunity. They look back and say, I could have traded that move. Of course they could have. Anyone can trade in hindsight. The real question is whether that move fit their plan at the time, with confirmation, structure, and room to breathe. If it didn't, then skipping it wasn't a mistake. It was professionalism. Do you judge your decisions by outcomes or by process? Timing also protects the mind. Every unnecessary trade adds emotional weight. Wins create overconfidence. Losses create frustration. Both distort judgment. By trading less, you keep your mental state closer to neutral, where charts are read more clearly. A calm trader sees what's there. An active trader sees what he wants to see. The market offers unlimited opportunity but limited clarity. Your job isn't to chase opportunity. It's to wait for clarity. That means accepting that most of your time will be spent observing, not acting. The trader who accepts this stops fighting the market's pace and starts sensing with it. That's when trading becomes less exhausting and more consistent. I learned that the market pays best when you arrive rested, patient, and slightly bored. When you feel no urgency, when you're willing to walk away if nothing appears. That mindset keeps you solvent long enough for probability to work in your favor. Without it, even the best strategy degrades under overuse. Restraint also preserves confidence. There's a special damage that comes from losing on bad trades you knew you shouldn't have taken. It doesn't just hurt the account, it weakens trust in yourself. And once the trust erodes, even good signals feel uncertain. Trading less but better keeps that internal trust intact. The market will be here tomorrow. The chart will print another bar, but your capital and your discipline are not guaranteed to survive constant activity. That's why restraint isn't optional. It's structural. It's the foundation that timing stands on. Without it, timing turns into chasing, and chasing turns into regret. When you finally understand that the market doesn't reward motion, you stop measuring your day by how many trades you took and start measuring it by how many bad trades you avoided. You begin to feel a strange satisfaction in closing the platform early, knowing nothing met your standards, knowing you protected your capital and your focus, knowing that patience is not empty time but preparation, and that when the right moment finally comes, you'll recognize it immediately because you weren't worn down by all the moments that didn't matter. A profitable trade doesn't justify breaking the rules that found it. That's a lesson the market teaches quietly at first, then violently if you refuse to listen. The trouble is that success is more dangerous than failure. A loss makes a trader cautious, a win makes him confident. And confidence, when it isn't anchored to rules, has a habit of wandering off on its own. Have you ever noticed how the most impulsive decisions often follow your best trades? When a trade works, the mind immediately looks for reasons to take credit. You remember the entry you timed well. You remember how sure you felt. What you forget is that the trade only existed because you waited, because you followed your plan, because you respected your own conditions. The profit didn't come from instinct alone. It came from structure. But once the money is booked, structure feels optional, and that's where the danger begins. I've seen traders treat a winning trade like permission. Permission to loosen the stop on the next one. Permission to enter a little earlier. Permission to ignore a missing confirmation because the market's hot today. That's how rules get bent without ever being formally broken. Each adjustment feels small. Each one feels reasonable. And then one day the trader looks at his account and can't understand why consistency vanished, even though his strategy hasn't changed. In truth, the strategy changed the moment discipline did. Rules exist to protect you from yourself, not from the market. The market will do what it wants regardless. Your rules are the only thing standing between randomness and ruin. When a trader breaks them after a win, he's telling himself a dangerous story that results matter more than process. That story always ends the same way. Sooner or later, the market delivers a trade that demands strict adherence, and the trader, now undisciplined, is unprepared. The chart doesn't care that your last trade worked. It doesn't remember your profits. It doesn't reward confidence. Each setup stands alone, and each one demands the same respect. When you ignore that, you start carrying emotional baggage from one trade to the next. You stop evaluating what's in front of you and start trading what just happened. That's not analysis. That's reaction. A rule-followed trade that loses is a good trade. A rule-broken trade that wins is a bad one. Most traders struggle to accept that. They let the outcome rewrite the lesson. They praise themselves for breaking rules when it works and blame the market when it doesn't. That reversal of responsibility is subtle, but it corrodes judgment faster than any losing streak. Do you review your trades by outcome or by execution? The market has a way of reinforcing bad habits just enough to make them stick. It gives you a win at the wrong time, so you'll repeat the mistake. That's why discipline must be non-negotiable, not flexible, not situational, non-negotiable. The trader who survives long enough to build real wealth is the one who treats rules as fixed costs of doing business, not suggestions that can be ignored when things feel easy. I learned that the hardest time to follow rules is when you feel good, when the account is up, when the last few trades worked smoothly. That's when vigilance is most needed, because success relaxes the mind, and a relaxed mind skips steps. It stops waiting for confirmation. It anticipates instead of responding, and anticipation is where most unnecessary losses are born. There's also a quiet arrogance that can follow a profitable trade. The feeling that you're in sync with the market, that you've figured something out others haven't. That confidence might feel empowering, but the market has no respect for it. The only thing it responds to is alignment. Alignment with trend, with structure, with volume, with timing. Rules are how you maintain that alignment. Without them, confidence turns into assumption. A trader's money mindset is revealed not by how he handles losses, but by how he handles wins. Losses force humility. Wins test restraint. The trader who can walk away after a good trade, who can wait for the next proper setup without forcing it, is the trader who understands that profits are rented, not owned. They can be taken back quickly if respect disappears. Breaking rules after a win also distorts risk perception. You start thinking in terms of, how's money? You tell yourself the next trade doesn't matter as much. That's an illusion. Every dollar in your account is your capital, regardless of how it got there. Treating profits as expendable is how traders give back weeks of work in a single afternoon. Have you ever noticed how fast gains disappear once that mindset takes hold? Consistency is built by repeating correct behavior, not by celebrating good outcomes. The market doesn't grade you on individual trades. It grades you on sequences, and sequences are shaped by rules. When you break them even once, you introduce randomness into a system that depends on order. Do it often enough, and the edge you worked so hard to define becomes unrecognizable. I've always believed that discipline is a form of respect. Respect for your capital. Respect for the market. Respect for the time it took to learn your craft. A profitable trade earned through discipline deserves respect as well, and that respect is shown by continuing to follow the same rules that produced it, not by abandoning them the moment they deliver. The irony is that traders who break rules after winning often think they're being adaptive. They believe flexibility is strength. In reality, flexibility without structure is just impulse. True adaptability happens within a framework, not outside of it. The rules don't limit opportunity, they filter it. Over time, the market separates traders into two groups. Those who let outcomes shape behavior, and those who let behavior shape outcomes. The first group rides emotional cycles, the second builds equity curves. The difference isn't intelligence or information, it's discipline under success. A trader who understands this doesn't feel the urge to press after a win. He doesn't feel invincible. He feels cautious, grounded, aware that the very trade that rewarded him could have punished him if conditions were slightly different. That awareness keeps him sharp. Every rule you follow reinforces your edge. Every rule you break weakens it, even if the trade works. And the market keeps track of that balance quietly, patiently, waiting for the moment when confidence outruns discipline, and the trader forgets that the rules were never meant to guarantee profits, only to protect him from the version of himself that believes a winning trade is proof that he no longer needs them. Impulsive trades are rarely about charts and almost always about emotion. That's an uncomfortable truth, because every trader likes to believe he acts on logic. He studies patterns, draws lines, watches volume, and tells himself every click is justified. But if you strip away the explanations, most impulsive trades come from a feeling that needed an outlet. Have you ever entered a trade quickly and then spent the next 5 minutes trying to explain why it made sense? Emotion doesn't announce itself loudly. It slips in quietly. It borrows the language of analysis. It points to a candle, a moving average, a minor breakout, and says, "There, that's your reason." But the reason existed long before the chart was consulted. The chart just became a witness. By the time the order is sent, the decision has already been made internally. An impulsive trade often starts with discomfort. Maybe the market is moving without you. Maybe you just took a loss. Maybe you had a good trade and now feel alert and energized. The emotion varies, but the result is the same urgency, and urgency is poison to clear chart reading. When you're rushed, you don't wait for confirmation. You don't measure risk carefully. You don't ask whether the setup fits your plan. You ask whether you can get in before it's too late. Charts are patient. They don't demand action. They simply print information. Emotion, on the other hand, demands relief. It wants resolution now. That's why impulsive trades often feel good at the moment of entry. There's a release. The waiting is over. The tension breaks. But that relief has nothing to do with probability. It's psychological, not financial. I've watched traders justify impulsive trades by pointing to indicators that weren't part of their system yesterday. They add meaning to minor movements because they want to participate. The chart becomes flexible when discipline becomes inconvenient, and once flexibility enters, rules lose their authority. Tell me, how often do impulsive trades come from your best setups? The market doesn't punish emotion immediately. Sometimes it rewards it. That's what makes impulsive trading so dangerous. A rushed entry can work. A poorly planned trade can make money. And when it does, the trader learns the wrong lesson. He starts trusting the feeling instead of the process. He confuses coincidence with insight. Over time, the account becomes a record not of strategy, but of moods. Emotion also distorts risk. When you're calm, risk is a number. When you're emotional, risk becomes an afterthought. Stops get wider. Position sizes creep up. You tell yourself you'll manage it if it goes against you. That's not management, that's hope. And hope has no place on a chart. Most impulsive trades don't come from ignorance. They come from impatience. The trader knows better. He's seen this pattern fail before. He's written rules to avoid it. But in the moment, the desire to act outweighs the desire to be right. That's why self-knowledge matters more than market knowledge. If you don't recognize your emotional triggers, the chart won't save you. One trader feels the urge after a loss. He wants to get it back. Another feels it after a win. He wants to press the advantage. Another feels it during slow markets. He wants excitement. Different emotions, same behavior. The chart becomes secondary. The trade becomes a response, not a decision. A clean setup feels different from an impulsive one. The clean setup feels calm. There's no rush. You can walk away and come back, and it still makes sense. The impulsive setup feels fragile. It needs to be taken now. It feels urgent because it's built on emotion, and emotion doesn't age well. Impulsive trades also break consistency. Even a good strategy can't survive emotional execution. The edge depends on repetition under similar conditions. Emotion introduces randomness. One impulsive trade might not matter. A habit of them will. And habits are built quietly, trade by trade, without dramatic warning signs. The market doesn't care why you entered. It only reacts to where you did and how you managed risk. Emotion doesn't improve entries. It only shortens decision-making. And shorter decisions in trading usually mean less information was considered, not more. There's a difference between intuition and impulse. Intuition is built from experience and still respects rules. Impulse ignores them. Intuition waits for confirmation it recognizes. Impulse acts to escape discomfort. They may feel similar, but their results are very different over time. A trader who wants longevity learns to pause. Not long pauses. Just enough to ask one honest question before entering. Would I take this trade if I felt completely neutral right now? That single question exposes most impulsive decisions. Emotion hates being questioned. It wants immediate action. The chart is always there. Opportunities repeat. What doesn't repeat easily is lost capital and lost confidence. Impulsive trades drain both. They create confusion because losses feel undeserved and wins feel accidental. Over time, the trader stops trusting his process because he hasn't been following one. When emotion drives trades, the journal fills with explanations instead of patterns. You see more words and fewer rules, more stories and fewer statistics. That's how traders drift away from structure without realizing it. The market rewards clarity, not urgency, and clarity only appears when emotion is quiet enough to hear what price is actually doing. Impulsive trades don't come from bad charts. They come from moments when the trader stops listening to them. Knowing when to stop is a trading skill equal to knowing when to enter. Most traders spend years studying entries. They memorize patterns, test indicators, refine timing. Very few give the same attention to stopping. Yet the market doesn't just test your ability to get in. It tests your ability to step away. Have you ever noticed how many bad trades happen after the good work is already done? The decision to stop trading is rarely about the chart. It's about the state of the trader. Fatigue, emotion, and overconfidence all blur judgment long before the chart changes. A tired trader sees late entries as early ones. An excited trader sees continuation where there is exhaustion. The chart didn't lie. The trader misread it because he should have stopped earlier. There's a point in every trading session where clarity begins to fade. It might come after a loss. It might come after a win. It might come after hours of watching nothing happen. That point is different for every trader, but it always arrives. The professional recognizes it. The amateur ignores it. The market doesn't forgive the difference. Stopping is not quitting. It's risk management applied to behavior instead of positions. Just as you place a stop loss to protect capital, you need a stop point to protect judgment. Without it, you trade past your edge and into your emotions. And emotions are always eager to trade when they should be resting. Many traders confuse discipline with endurance. They believe staying at the screen longer makes them more serious. In reality, endurance without clarity is just exposure. The market doesn't reward the last man standing. It rewards the man who exits before mistakes become inevitable. I've seen traders give back an entire morning's profits because they refused to stop after reaching their daily limit. They told themselves they were still sharp. The chart looked similar. The only thing that changed was their internal state. Confidence turned into pressure. Patience turned into expectation. The trades that followed weren't bad setups on paper, but they were taken by the wrong version of the trader. Knowing when to stop also protects your relationship with the market. When you walk away on your own terms, you return with respect intact. When you're forced out by losses, frustration lingers. That frustration shows up in the next session. One bad stopping decision can echo for days. The market offers endless opportunity, but your focus is finite. Once it's depleted, analysis turns shallow. You stop seeing the whole structure and fixate on small movements. That's when overtrading begins. Stopping before that happens preserves the quality of your decisions, not just the quantity. A trader who masters stopping understands that profits are not maximized by squeezing every possible trade out of a day. They're maximized by protecting the conditions that allow good trading to happen repeatedly. That means leaving money on the table. And that's uncomfortable for most traders. Do you measure success by money made or mistakes avoided? Stopping requires humility. It requires admitting that your edge doesn't operate under all conditions, including internal ones. The trader who believes he can trade through any state is the trader who eventually learns the cost of that belief. The best trades are usually obvious in hindsight because they happened when the trader was fresh and selective. The worst trades are often clustered together, taken late, rushed, and poorly managed. That clustering isn't random. It's a sign that the trader should have stopped earlier. There's also a subtle freedom in stopping. When you know you can walk away, you stop forcing trades. You stop feeling trapped by the screen. You trade because conditions are right, not because time is passing. That shift alone improves decision-making. Stopping at the right time reinforces discipline. It builds trust in yourself. Each time you stop according to plan, you prove that you're in control of your behavior, not just your entries. That self-trust carries into every part of trading. Some traders wait for the market to tell them to stop. The market will, but it charges tuition for the lesson. The smarter approach is to stop before the lesson is needed. That's not fear. That's foresight. The skill of stopping is built the same way as any other skill, through rules, repetition, and honest review. A daily loss limit, a profit target, a time-based cutoff, or a mental checklist can all serve as stopping mechanisms. What matters is that they're respected. When traders ignore stopping rules, it's usually because they feel capable in the moment. That feeling is unreliable. The chart doesn't change because you feel capable. Probability doesn't bend to confidence. Stopping is how you stay aligned with probability instead of emotion. Over time, traders who learn to stop find that their equity curves smooth out, drawdowns shorten, confidence stabilizes. Not because they trade less, but because they trade only when they are able to trade well. Knowing when to stop is what keeps a good day from turning into a bad one, a bad day from turning into a disaster, and a long career from being cut short. The market will always offer another setup, but it won't always offer you the right mindset to take it.